Personal Lines Practice Exam. Welcome to the quiz. For a personal watercraft policy, what is agreed value coverage? Is it A, coverage that pays the actual cash value at the time of loss? Or B, coverage where the insurer and insured agree on the value upfront, which is paid in the event of a total loss? C, coverage that agrees with the market value? Or D, coverage that is agreed upon after a loss occurs? The answer is B. Personal watercraft like jet skis or boats can depreciate quickly, and actual cash value payouts might leave owners underpaid for total losses. Agreed value coverage lets the insurer and insured set a fixed amount in advance, often the purchase price or appraised value, listed on the policy, and in case of total loss, the insurer pays that full pre-agreed amount without deducting depreciation. This provides certainty and better protection. Actual cash value subtracts depreciation. Market value fluctuates and isn't fixed. Post-loss agreement wouldn't help for total losses. Agreed value locks in the settlement amount up front for total loss scenarios. Next question. What is a conditional receipt in life insurance? Is it A, a receipt given when an application is submitted, which may provide temporary coverage if conditions are met? Or B, a receipt for the down payment on the premium? C, a receipt that is conditional on the policy being delivered? Or D, a receipt from the medical examiner? The answer is A. When someone applies for life insurance and pays the initial premium, the agent often issues a conditional receipt. This receipt provides temporary interim coverage from the application date if certain conditions are satisfied, typically that the applicant is insurable at standard rates on the application date, no changes in health, no misrepresentations, and the policy is eventually issued as applied for or better. If approved, coverage backdates to the receipt date. If declined or rated up, no coverage under the receipt and premium refunded. It's not just a down payment receipt without coverage potential. Delivery isn't the trigger. Medical examiner receipts are separate. The conditional receipt bridges the gap with limited temporary protection pending underwriting. Next question. What does insurance to value mean for a homeowner's policy? Is it A, insuring the dwelling for at least 80% of its replacement cost to avoid a coinsurance penalty? Or B, insuring the dwelling for its full market value, including land? C, insuring the dwelling for the amount of the mortgage? Or D, insuring the personal property for its full value? The answer is A. Homeowners' policies often include a coinsurance clause requiring the dwelling to be insured for at least 80%, sometimes 90% or 100%, of its full replacement cost at the time of loss. If underinsured below that threshold, a penalty reduces the payout proportionally. For example, if insured for 60% of replacement cost, only 60% of the loss is paid, minus deductible. Insurance to value means maintaining coverage at or above that percentage to receive full replacement cost settlement without penalty. Market value includes land, which isn't covered. Mortgage amount is lending concern, not insurance adequacy. Personal property has its own limit. The concept ensures adequate dwelling coverage to avoid underinsurance penalties. Next question. What is the primary purpose of trip interruption coverage in a travel insurance policy? Is it A, to cover the cost of returning home early if a trip is interrupted for a covered reason, e.g. illness? Or B, to interrupt the traveler's plans? C, to cover the cost of medical care abroad? Or D, to insure against lost luggage? The answer is A. Travel insurance helps protect against unexpected disruptions during trips. Trip interruption specifically reimburses non-refundable prepaid expenses, flights, hotels, tours, and provides funds for alternate transportation home if the trip is cut short or must be abandoned for a covered reason like serious illness, injury, death in family, natural disaster, or terrorism. It focuses on getting back home early or covering lost prepaid costs due to interruption. It does not cause interruption. Medical care is covered under separate emergency medical benefits. Lost luggage has its own coverage. The primary goal is financial protection for shortened trips due to covered emergencies. Next question. In a disability income policy, what is the difference between own occupation and any occupation definitions of total disability? Is it A, own occupation pays if you cannot perform the duties of your specific job? Any occupation pays only if you cannot perform any job for which you are reasonably suited. Or B, they mean the same thing. C, any occupation is a more liberal definition that pays benefits sooner. Or D, own occupation applies only to self-employed individuals. The answer is A. Disability income policies define total disability differently, affecting when benefits start and how long they last. Own occupation, true own OCC, pays if the insured cannot perform the material duties of their regular occupation, the specific job they trained for and were doing, even if they can work in another field. This is more favorable to professionals like surgeons or pilots who can't do their exact work but could do something else. Any occupation, or any OCC, pays only if the insured cannot perform any job for which they are reasonably suited by education, training, and experience, a stricter test that cuts off benefits sooner if alternative work exists. They're not the same. Any OCC is more restrictive for the insured. Own OCC applies broadly, not just self-employed. The difference is specificity of the job considered for disability. Next question. What is builder's risk insurance? Is it A, a type of liability insurance for construction defects? Or B, a property policy that covers a building under construction? C, insurance for the risk of hiring a builder? Or D, home warranty insurance? The answer is B. During construction, renovation, or addition, a building and materials face risks like fire, theft, vandalism, wind, or collapse before completion. Builder's risk insurance is a specialized property policy that covers the structure being built, materials on site, and sometimes temporary structures or equipment against covered perils during the construction phase. Coverage usually lasts until the building is completed and occupied or a set date. It is not liability for defects. That's completed operations or professional liability. It doesn't insure hiring risks. Home warranties cover post-construction systems. Builder's risk protects the insurable interest in the unfinished building and contents during construction. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.